transactions in the space and then discuss some of the trends that are behind many of the transactions that are occurring today. Finally, I'll cover the details behind the ASC valuations we perform and highlight some of the unique details particular to ASC valuations, and then I'll open it up for questions. First, we start out with a short historical review of ambulatory surgery centers to put our current situation in perspective. In the late 1960s, inefficiencies in hospital-based surgeries provided the impetus to begin something new, the ambulatory surgery center, which was focused on a few surgical procedures and provided more physician control over the surgery environment. Long wait to the hospital, scheduled surgeries being bumped for emergency procedures, and limited physician control over the environment prompted the launch of the ASC. During the 1970s and the 1980s, the success of this more efficient and lower cost alternative led to tremendous growth and Medicare participation. This success and technological improvements in surgeries also increased the number of procedures that could be addressed at an ASC, and the United States experienced growth from just a few centers in the early 1970s to over 3,000 by the end of the 1990s. Over the last 15 years, growth has still been strong. However, it has slowed as the market reaches saturation and payment disparities continue to increase between payment for hospital-based procedures, also known as HOPD, and freestanding ASC-based ones. Reimbursement pressures, combined with saturation and slowing same-facility comparisons, have created an environment that is ripe for consolidation, and in response, several management and development companies have come to the forefront, providing an opportunity for independent ASCs to sell part of their equity in return for improved center management and a stronger negotiating position. Physicians are also interested in selling to hospital partners due to the potential for higher HOPD rates, which can support desired salary growth. Hospitals are favorable towards consolidating the industry in an attempt to align with physicians while still providing a low-cost option to patients. ASCs saw tremendous unit and volume growth in the 1970s to the early 2000 period, and you can see the 2000 to 2013 period in this next slide in terms of annual growth rates. However, the rate has slowed significantly in recent years. As you can see, in 2001, we had a rate that was above 10%, which has declined now in 2013 and 2014 to below 1%. ASCs have seen strong growth and have become such an important part of our healthcare environment because they provide a needed service in a lower cost and more efficient setting as compared to a hospital. A 2004 cost study undertaken by the Government Accountability Office found that ASC costs are lower and visits are shorter as compared to hospital outpatient departments, bolstering the argument that this approach to surgery is a successful one. The ASC is also generally focused on a few procedures, which allows for specialization of equipment, personnel, and practices. Other studies have shown, including one undertaken by MedPAC in 2009, that ASCs have higher levels of patient satisfaction when compared to surgeries performed in the hospital. As is evident here, ASCs have much to offer in terms of cost, efficiency, control, and patient satisfaction, which explains why they have become such an important part of our healthcare environment in recent decades. As when any fast growth industry slows down, consolidation becomes a more important part of the landscape. The ASC exists in a mature industry with slowing unit growth and slowing revenue comps. The difference between hospital rates and ASC rates, known as the HOPD rate disparity, is another factor that is driving transactions. In its most recent report to Congress, MedPAC reported that hospital rates are 81% higher than they are for freestanding units. The rate difference will continue to widen next year as the final rate increase for HOPD rates is 2.2%, while it is only 1.4% for freestanding units. The difference provides an opportunity for higher pay through employment if the ASC is converted to a hospital-based service. In terms of reimbursements lagging inflation, all Medicare services are subject to additional pressures from mandatory Affordable Health Care Act reductions, sequestration, and productivity adjustments, which result and government reimbursement growth that falls behind inflation, and the ASC's own labor and expense trends. For the mature industry, we reviewed trends reported by the largest public ASCs and found that year-to-date comps as of the end of the third quarter, 2014, were 0.6%, 2.4%, and negative 0.1% for AMSURG, Surgical Care Affiliates, and HCA respectively. And these companies represent some of the largest groups of ASCs that are out there, and they also tend to focus on the higher growth areas. So our assessment is that probably on average comparisons are a little bit lower than the 0.6, 2.4, and negative 0.1 rates that they cited for year-to-date numbers. Another burden felt by the ASCs is the requirement for additional reporting of quality metrics as a cost item that's not factored into Medicare reimbursement. Hospitals are attracted to the ASC model as it is lower cost for most outpatient surgeries. Convenience for patients in terms of location and ease of navigating the center help maintain high levels of utilization. ASCs can also be an important part of the ACO strategy, allowing for greater integration and passing on the administration of the center to a larger organization, which can more cost-effectively run it. A physician group selling their ASC to a hospital will not only provide the opportunity for higher ASC profits through Medicare reimbursement, but will also reduce the administrative and IT burden, allowing them to be taken over by a more experienced partner. Our next slide, ASC buyers and transaction types. The ASC industry is fragmented. According to Hoover's, the top 50 companies generate 30% of the industry's revenues. ASCs are commonly owned through hospital direct equity ownership in a JV with physicians. A management company may also be a partner, which will receive a management fee for dealing with administrative responsibilities. In terms of a breakdown by ownership, of the over 5,000 ASCs nationwide, 1,500 are owned by management companies and 1,500 are partially owned by hospitals. We have included some of the largest ASC management companies on this slide. AMSURG has 235 surgery centers, USPI with over 200, Surgical Care Affiliates has 185, and Symbion has 57 facilities. The largest player in this group, AMSURG, continues to add centers, and they announced on their latest conference call that they added 4 ASCs in the quarter and have 8 letters of intent outstanding. The most popular transaction types are listed on the slide, including minority and majority stakes, as well as joint ventures. It's important to maintain a physician interest in the center if possible, as physician volume is key to the center's success. Two big ASC deals were both announced and closed this year. Symbion and Surgery Partners were brought together by private equity firms in a deal that valued Symbion at $792 million, valuing each unit that they have at near $17 million. As a multiple of revenues, Surgery Partner paid 1.5 times 2013 revenues. Combined, the companies will have over 100 units going forward. An interesting note on this deal is that private equity firms own both of these companies that joined together. Despite being a fragmented market, as a condition of allowing the merger, the FTC is requiring Surgery Partners to divest one of Symbion's Florida surgery centers that is close to one of its own facilities. They are concerned that this will reduce competition in the market. In the other big ASC deal, AMSURG bought physician outsourcing provider Sheridan in a cash and stock deal valued at $2.35 billion. While AMSURG didn't buy another ASC group, it does show where the interests in the industry lie. Access to physicians, specifically anesthesia. The deal was completed on July 16th. There are a number of considerations that must be addressed when performing valuations in the healthcare space. For designated health services, the Stark Law and the federal anti-kickback statute are applicable. However, ambulatory surgery centers are not classified as designated health services. Anti-kickback is the driver for most ASC valuations, which require a fair market value to be determined. There are a number of safe harbors under which an ASC can be operated, which allows the ASC to avoid being subject to anti-kickback. But for ASCs that do not satisfy the safe harbor, an FMV valuation is an important protection. The FMV valuation can also address some indirect stark risks relating to ancillary services provided in conjunction with work performed at the ASC. Stark may also be an issue if the hospital investor in the ASC has other relationships with the physician investors in the ASC. As such, it is important to have a fair market value performed. Included on this slide are the detailed definitions of fair market value as provided by IRS Revenue Ruling 5960 in the Stark Law. Basically, FMV is the price that would be determined by two independent parties with sufficient information to value an asset or service that does not take into account the value of referrals. And I'll give you all a moment to skim through that and see some of the details that are in those definitions. In this next section, I'm going to cover the three approaches to valuation that we use. These include the income approach, market approach, and cost approach, each with their own situations where they're applicable. There are two methods under the income approach: discounted cash flow, or DCF, and single period capitalization method. The DCF, which uses estimated cash flows over multiple periods, is most commonly used as it takes into account anticipated trends in revenue and cost items. The single period approach is applicable if there is a steady growth rate anticipated in the single period cash flow that's evaluated. The income approach is used most frequently when there are positive cash flows and sufficient information to forecast revenue growth and cost trends. This approach is best able to address changing trends in revenues and costs and generally creates a pro forma cash flow forecast over the next 5 years. We consult with ASC management and review local and national trends and reimbursements and costs to generate our cash flow model addressing personnel expenses, fixed and variable expenses, capital expenditures, and other key items that determine the profitability of the center. After we estimate the cash flows over the forecast period, we then determine a discount rate, or weighted average cost of capital, to calculate the present value of the cash flows. Some of the factors that are considered in this calculation include the risk-free rate and the risk premium. We also need to determine the terminal growth rate for the cash flows, and generally we use the anticipated inflation rate and population growth, among other factors, when estimating this. Other key items for building our DCF model include our outlook on reimbursements, paying particular attention to Medicare trends, case volume, case mix, demographic characteristics for the area served by the ASC, and adjustments for services that will be assumed under the management fee, such as billing, IT, payer negotiations, legal, coding, and other items. Generally, the management fees for ASCs range from 5 to 7%. An additional consideration is out-of-network billing. While reimbursements here are higher, there is pressure on out-of-network rates and participation. A high level of out-of-network revenues may require a downward adjustment. The market approach uses market information from public companies that are freely traded in the market to value the asset, security, or service that we're considering. Market data is used to generate a multiple of earnings, cash flow, revenues, or other metric which is then applied to the subject company. We include 3 companies above which have either a majority or a significant amount of their business in ambulatory surgery centers. Due to size, access to capital, market dominance, and other factors of the companies included in the data set, these results may not be comparable with valuations appropriate for smaller ASCs. The M&A method examines transactions between buyers and sellers for the sale of the entire company or operating units of companies. While this approach does provide an indication for what buyers and sellers are willing to pay and receive, it may be difficult to determine what assets are being included, what agreements may be tied to the transaction, and also may include a premium for investment value, which is not considered under fair market value. In the 3 ASC representatives that we consider here, 2 have other non-ASC businesses that may distort the appropriate multiple applicable to ASC-only scenarios. We use 2015 revenue and EBITDA estimates on current prices to determine the trading multiples. I'll give you all a minute to take a look at what we've got here. The market approach is more difficult to apply than it might first seem. For the market approach to be applicable, there must be a material degree of comparability in terms of services, size, access to capital, location, and other factors which we list. In many cases, only larger companies trade in the markets and provide the necessary data, and as such, they do not capture the riskier nature of the smaller and single-unit ASCs that has a material impact on their valuation. Despite this, the market approach can provide useful information and be a sanity check for values determined through the income approach. On this slide, we provide a summary of mostly private ASC transactions over the last several years and find a median of 7.6 times EBITDA. We note that the valuation depends on whether a minority or majority interest is sought, and also whether or not the ASC is a single specialty or multi-specialty entity. A discount is given for a minority interest and for single specialty centers. A majority interest in a multi-specialty ASC obtains the highest multiple that, according to some surveys, can be as much as 3 to 4 EBITDA multiple points higher. Other factors that are considered include anticipated growth in the ASC, as well as economic activity and population trends in the relevant geographic area. Based on our observations, in general, a single specialty minority interest in an ASC is valued from 3 to 4 times EBITDA, and a majority interest in a multi-specialty ASC generally ranges from 6 to 8 times EBITDA. We note that some of these transactions are associated with non-hospital or non-physician buyers and do not represent FMV. These multiples are not applicable to ASCs and physician hospital transactions and can't be supported under FMV. In some cases, where there are losses or only limited cash profits from the subject company, we apply the asset approach. This approach values the hard assets that are used in the operation of the businesses and may also value intangible assets, such as brand name, workforce, or certificates of need. There are 3 premises that can be applied under our asset approach, which we list on the slide. Most of our valuations that employ the asset approach value the assets as a going concern. The asset approach is not the primary method used and only comes into play when other methods are not applicable or indicate a value lower than the asset approach. As such, this approach provides a floor value for a going concern business. This concludes a review of ASCs, some background on why they are important, and the approaches used to determine their value. Some of the key points are that ASCs have seen tremendous growth over the last 40 years, but are currently near saturation and entering a consolidation phase. This change means that more transactions will be taking place, and buyers and sellers will in many cases need a fair market valuation to consummate the transaction. Healthcare is highly regulated, and as such, many rules apply. In this case, anti-kickback is a key issue to consider, and FMV must be used. As for the valuation approach, the income approach is preferred, as it accounts for the many moving parts that are key to determining the value of a cash-generating asset. In our review of the market approach, we find a wide range of multiples paid, with some including investment value and other elements that do not represent FMV. We caution our audience that the majority of smaller ASC transactions range in the 4 to 5 times EBITDA range, but can vary based on anticipated growth rates. We hope that you have enjoyed our presentation today and want to open up the lines for your questions. Charlie, can you provide instructions for our audience?
Yes, if you have any questions, you can just type them into the panel on the side that's provided by GoToMeeting.
If anyone has any questions on any of the slides, feel free to send them on, and I'll do my best to answer them. Give you all a moment to put it in. One thing that I think a lot of people want to know about is just what are some of the key value drivers for ASC valuations. And I mentioned some of those on an earlier slide, but what we try to pay attention to, there are a few components that go into the valuation. One is on the revenue side, And then there are several factors that play into that. And then also there's the cost side of things. And those are the two main areas that we look at in terms of coming up with, a final valuation number. On the revenue side, we'll see things, we'll look at Medicare reimbursement rates. For ASCs in particular, we'll look at case mix. I mean, that's very important. Some areas are much more profitable than others. And some areas are also increasing while others are decreasing. Every year, Medicare adds and subtracts types of cases that can be done at ASCs. So, we also try to keep an eye on that to help determine where we're going. Trying to think what else. And then on the cost side of things, one of the things that has been going on pretty much across the board in healthcare is that reimbursements are lagging costs. Employee costs have continued to rise faster than the rates that reimbursements are getting. And especially when you look at HOPD versus the ASCs, the inflation rate that they use to adjust the rates is much higher on the hospital side than it is for the ASC side. So that has been providing substantial pressure over time, and is another factor that we look at when trying to come up with a reasonable valuation. Do we have any other questions out there? Another question that I've gotten was on, is this a good time to sell? And in many ways, I think it is a good time to sell. As I mentioned in the presentation, comps are slowing, ASC growth is slowing, and I think there are benefits to be had from consolidation in terms of consolidating some of the administrative functions, in terms of consolidating the centers into the most efficient ones. As you saw from the one transaction that took place between AmSurg and Sheridan, one of the reasons I think they did the transaction is to provide more physicians to perform their surgeries in the centers. Over time, I've seen some data that suggests that physicians per surgery center has been declining, and one of the big drivers for surgery centers is getting more procedures done there. And if you have fewer physicians per ASC, then that's going to pressure that. ASCs are a very high fixed cost entity, and once you cover your fixed costs, the profits come pretty quickly. So that underlines the importance of increasing the number of physicians that participate in the ASCs, and I think right now, in terms of it being a good time to sell, taking advantage of some of those benefits is pretty good right now. Well, I don't see any other questions. So I'll give just another few seconds to see if anyone has a last-minute item to send on to me. And if not, I thank you all for participating today. And if you have anything that you want to follow up with me on, please feel free to send on an email, and I'll be happy to answer your questions. Charlie, do we have any final things that we need to cover before letting our audience?
I think that's going to be it. As John mentioned, if you have any questions or want to follow up with him, then please do so at jvandermosten@cokergroup.com. Other than that, we'll be sending out the presentation and a recording of the presentation by tomorrow, so you can view it at your own convenience or flip through it with the slides. Again, I appreciate you all joining us today and look forward to December's Coffee with Coker. Thank you.
Thank you.